colleagues. Thank you for joining. I believe we can start. Uh,
Okay, Irina, then you think we are ready? Yes. I saw like almost 20 people is online. In this case, let's wait just 1 minute. Maybe somewhere else will join us and we'll be ready to start the presentation. Oh, already 12, 20. Okay. Okay, great. Then let's start. Good afternoon, everyone. My name is Andrei Kulik. I'm a manager in Deloitte. Today I will be a moderator of a very interesting presentation led by Antonella and Mark. So this presentation is a part of a valuation workshop organized by CFA Society Ukraine. So thank you CFA Society for initiating this series of valuation workshops. And the topic of today's presentation is, I would say, very interesting for me professionally as well as a appraiser with experience. It is evaluation of digital tokens. And today, so our speakers is Antonella and Mark. So I hope Antonella and Mark, can you introduce yourself and say a couple of words, okay? And let's start a presentation and hope for very interesting speech. So ready?
Thank you so much,
Oh,
Andrei. Thank you for the introduction. I would like to thank all the participants for attending this webinar at this very challenging moment. I have been very moved and impressed by the Ukrainian bravery, resilience, and determination, and I am honored to speak with you today. So, in terms of myself, I'm the managing partner of Blue Val in New York, which is a specialist valuation firm. We work with private equity, venture, and private credit funds, primarily their managers and their portfolio company, and we service their valuation needs. I am based in New York City. I am a member of CFA Institute. Having the CFA charter has been critical in my career. I often talk about it with my team, and one of the great advantages of the charter is precisely the interaction with among members from different parts of the world, and which is what also resulted in us being connected. So I'm very grateful to CFA Institute for this program. I wrote a book on early stage valuation, as you see, which is available from Amazon and other sources. And I'm very glad to be here today. And Mark?
Hi, good afternoon, everyone, and thank you for the opportunity to present to you this afternoon. I am Mark Zyla. I am managing director of my own firm, Zyla Valuation Advisors, which is based in Austin, Texas, which is a boutique valuation litigation services firm. In addition to providing valuations, I'm also a member of the faculty of the University of Texas at Austin, where I teach a course to graduate students on valuations, particularly in the area of consultancy. In addition to um, those roles, I have a specialist particular expertise in fair value measurements. I've written a lot of texts on fair value. I've worked with a number of organizations, particularly the International Valuation Standards Council, IVSC, where I was chairman of the Standards Review Board for 6 or 7 years. So I appreciate the opportunity to present to you and look forward to this presentation.
Okay, I think we can start. Just in terms of the agenda, we're going to focus on the valuation of digital tokens. We'll provide a market overview. I will talk briefly about the regulatory environment, and I want to make it clear that we are not attorneys. We are not commenting on legal. We're not giving legal advice, but as you will see, an understanding of the regulatory environment has very direct implications for valuation. So that's what we're going to focus on. And then we're going to dig into some specific issues that relate to the fair value of digital tokens. We'll give you some examples from our practice. We'll talk a little bit about simple agreements for future tokens, which are special types of contracts that have emerged in the crypto space. We'll also give you a sense of what's going on with the US Securities and Exchange Commission in terms of enforcement cases relating to digital tokens. And then we will give you some references in case you wish to find out more about the topic of this presentation. And then we'll have our Q&A session. So with that, I'll pass it along to Mark that will give you a market overview.
One of the interesting things about valuing digital tokens or digital assets in general is that even though it's an evolving technology, that standard valuation metrics typically apply. It's just how it's applied to this particular purpose. So the first thing that we want to look at when we're considering particularly the fair value of digital tokens is we want to look at the market as a whole, similar to what we do with any type of valuations. So it's an interesting market. What we're showing on this slide is currently, at least as of earlier this week, the total market capitalization for the crypto market was about $2.5 trillion. That's down from a peak in 2025 of about $4 trillion. So as you can tell by the graph, it's an incredibly volatile market, which plays into some of the valuation techniques that Antonella and I are going to discuss later. The landscape is incredibly diverse. There's over 16,000 types of tokens that are currently being tracked. So there may be opportunities or situations where you're involved in an evaluation or you're asked to value a particular token that's not as widely with a lot of volume. So we'll discuss some of the techniques. One of the aspects of the valuation of the total crypto market is the exchanges that these tokens are actually trading on. When you're looking at a relative approach or a market-based approach, is that there's about 1,500 different exchanges. So it makes fair value measurement when you're looking for a principal market, makes it a little bit difficult to identify that principal market or challenging. Next slide, Antonella. So as part of the overall global landscape, you first start thinking about what is the digital token or the digital asset that you're actually asked to be measured at fair value. And there's some broad categories. One is the digital currencies, which are typically mediums of exchange or stores of value. Which is one type of digital token. A second type is a utility token, which is a token that is designed for a particular function. So it's not a claim on ownership or a profit incentive, but it provides some incentive. Like, for example, it might unlock energy sources, or it might unlock particular functions in various other aspects. And of course, these have value, but it's not at like thinking about a particular security or an exchange. So there are different methodologies that we'll look at to measure those values using market-based approaches. Other common digital currencies or digital tokens are stable coins, which are tokens that are tied to typically a fiat currency like the US dollar, or there are now increasing numbers of central banks that are offering digital currencies in addition to traditional paper currency, and that's becoming much more common. Um, the cryptocurrency market by market cap is a massive concentration of value into just two or three different types of digital assets currently. The most common, obviously, is Bitcoin, which has a market capitalization of $1.6 trillion. So it's by far the market leader as far as market capitalization. And that's followed by Ethereum and Tether, which have market caps of about 275 uh, billion and about $188 billion. So it's a very the value of by market cap is very concentrated just in three different types of currency. So it may make relative valuations a little bit more difficult. Next slide, please. Um, so this again shows just Bitcoin's dominance in global markets as a percentage. It which is percentage of total market capitalization is held by Bitcoin and specifically other assets. So just again highlights the dominance of Bitcoin and Ethereum compared to the total market. Next slide, please. So when we're thinking about fair value measurements, and one of the basic tenets of fair value is that it's an exit notion, that it's not necessarily the price that you acquired the asset at, but what you could sell it for to a market participant. So in order to apply those principles of fair value to digital assets, you also have to understand how that particular digital asset or digital token has access to market. And so it requires an understanding of where the exchanges that the coin is traded on, but also it requires an understanding of how these particular markets operate. So some things that you may want to consider are spot and future markets, which have robust crypto futures as far as different exchanges. There are also exchange traded funds, which is an investment fund traded on traditional stock exchanges that are devoted to digital assets, which can be used to benchmark value in starting the process for measuring fair value. And then also increasingly, valuation specialists are looking at crypto indices, um, indices such as the coin market cap, which is an equal weighted index, which is a good starting point for looking at just overall trends in the crypto market when you're starting to measure the value of an individual digital asset. Next slide, please. And then when you're as a starting point, when you're understanding the market, where the particular digital token is actually traded, and looking at indices and other reference points, it's also important to understand the characteristics of the digital token itself, just similar to any type of other asset that you're measuring fair value. So things that you may want to look at that are unique to digital tokens are the adoption and market confidence of that particular digital asset. As we noted in previous slides, the concentration market cap is really focused on three particular different types of digital assets or digital currency. And so if you're measuring the fair value of a token other than those top three, one of the things you have to think about is the market and the volume and the liquidity of that particular subject digital asset and whether or not it's actively traded. So if you may want to look at it, the market confidence and its adoption. Other factors that are unique to digital assets and valuation is the regulatory framework, and Antonella and I will speak to that in a few minutes about how that impacts the valuation of various digital assets. But increasingly, these type of assets are coming under the scrutiny of regulators. And of course, similar to any other type of asset that becomes regulated, it has an impact on overall value. A couple of other items that one must consider when looking at the measuring the fair value of a digital asset is just the technology itself. The technology is still evolving. So you have to look at the security, whether it's scalable, of the underlying blockchain that supports the value. And then lastly, one of the biggest drivers, similar to any other type of security or other type of asset, is just the supply and demand and liquidity. And we'll talk about how we actually measure those type of issues in digital assets.
Thank you, Mark. So before we start digging into the quantitative side of the presentation, the regulatory update, we want to highlight the importance of stable coins in the crypto framework. And stable coins have a very important role in that these are tokens that act as an intermediary step between the fiat world of regular currencies and regular, ordinary investments and the crypto environment. So if you want to buy Bitcoin, you cannot just go and buy Bitcoin with your US dollars. You have to go through a step, which is you have to, assume you want to hold the currency, the token directly. You basically, the first step is going to be converting your euros or your US dollars into a token that is pegged to a fiat currency, and then use those tokens as currency to buy your whatever token you want on the crypto in a crypto exchange. So these tokens have a very important role, and the idea is that they are called stable coins because one of their critical features is that of maintaining a peg to an actual fiat currency, which can be the US dollar typically or the euro. So Tether is one of the two most important stable coins. In the past, up to very recently, there have been two versions of Tether, one in US dollars and one in euro. So we're looking now at the 1-year chart of Tether. And the important aspect of this chart is, first of all, is whether Tether has been able indeed to maintain its peg. So, and you see that generally speaking, it has done a pretty good job. The oscillations have been between 0.99 to a dollar and one a little bit, less than 1.002. So the band has been pretty good, but still there is the possibility of situation where that peg has come into question, or may come into question in the future. So, perhaps not for Tether or for other stable coins, but this is something to keep in mind. So, the first thing is whenever you're looking at a token, to consider what is the stable coin that underlies it, and how this conversion step is gonna most likely take place, and whether it affects valuation in any way. So one very important feature of stablecoins is that in order to maintain their peg, stablecoins need to be backed by, by reserves. Oh boy. I'm sorry, I don't know how to block this. Okay, so generally for stable coins, so they're backed by reserves. So if we the other consideration before we go to the reserves is, you see, we have a different chart for the Tether in euro. Here we have one-year chart that shows, a situation where Tether actually was depegged. And the reason of the depegging is that Tether discontinued support for Euro AT for regulatory reasons. And essentially, the peg was suspended, and Tether committed to wind down its role in the European stablecoin market. And so you see the effect of that, obviously, on the peg. So this was a voluntary suspension, but this is something that shows, what could potentially happen in a situation where, for whatever reason, the peg is broken. And now let's take a quick look at the Tether reserves. So in order to maintain the peg, stablecoins typically are backed by reserves that have to support their conversion. And the interesting feature is that as the crypto market grows and as more of the stable coins are being in circulation, the reserves, obviously the reserve volume is going to grow accordingly, and a very significant investment of the reserves takes place in US Treasury bills and in US government securities overall. So this gives you a sense of how the holdings of US government treasuries have been increased over time in the Tether USD. And at the moment, Tether holds about 0.32% of US debt. To put this in context, China has about 1.8% currently. So, basically these stable coins are becoming important players in the US Treasury market. And part of the reason why regulators across the world have started to get into this space more and more is because there is starting to be a tie between greater and greater tie between the treasury, the state of the market for government securities, and the crypto world. Also, another important feature of Tether is that Tether as a company is accumulating a lot of cash, and they're becoming also a player separately from the reserves, in part from the reserve, but also separately with the extra cash in the VC market. So these are examples of holdings of Tether in startup investments as of March 26. And with that, we'll pass to the regulatory framework. So in the regulatory framework is again, we're not going in depth into it, but we want to give you an idea of what is most relevant from a valuation perspective. So in Europe, there is since December 2024, the markets in crypto asset regulation has become applicable in all the 27 EU member states. And this particular regulation really provides, compliance with the regulation provides a passport for certain stablecoin issuers, in particular, to be active across the European Union. Also, an important feature of the MiCAR is that it is fully applicable. It doesn't require the need for transposition into a national law. The MiCAR Act is primarily focused on stablecoins, and they distinguish asset reference tokens, which refer to a basket of assets, from e-money tokens, which refer typically to a single currency peg. And then they differentiate e-money tokens, for instance, from other crypto assets like utility tokens or governance tokens, which don't require prior approval from the regulators. Also, they identify a particular category of tokens as significant tokens based on a certain volume and trading volume characteristics that are subject to the European Banking Authority. One important feature of MiCAR is that it has provided some specific requirements for the white paper document that generally accompanies the issuance of tokens. So there are some specific elements that the white paper has to include. And typically, when we value a token, the white paper is really a starting point. It's like you want to understand who the issuer is, how the issuance of the token works, what are the rights and obligations of token holders, how has the project been developed, what are the risks of a particular token. So the white paper is a very good point to start on that. In the US, on the other hand, there has been recently the passage of the Genius Act, which is the first major US crypto legislation focused on payment stablecoins. So one very important feature of the Genius Act is that it mandates that there shouldn't be a payment to the holders of stablecoins. So basically, you have money that is generated from the reserves. And from the point of the issuers, one advantage of the Genius Act is that they are basically allowed, or even in some cases required, to keep any profits that's generated from the reserves. While MiCAR in Europe gives more flexibility on that point in terms of allowing some of that revenue generated from holding US treasuries, for instance, to be passed along to the stablecoin holders. So that's a difference. And this, the Genius Act in a way tends to, one of the key purposes was to make stablecoin more transparent, more reliable, and also to sustain the demand of US government securities and enhance the profitability of the US stablecoin market, particularly for issuers. And with that, I'll pass it to Mark, who is going to talk about the digital assets practice aid of the AICPA.
Yeah, as we pivot from discussing the overall market and the characteristics of digital tokens, start focusing on how you actually measure these type of assets at fair value. And fortunately, the profession has helped us a bit with some guidance. So the AICPA has developed a digital assets practice aid, which provides some non-authoritative type of guidance on accounting for digital assets, which includes obviously the fair value measurements, which is subject to today's webinar, under US GAAP. And even though it's designed for US GAAP, because there are a lot commonalities between ASC 820 and IFRS 13 under fair value measurement, since they're very similar types of statements or the same statement, and fair value measurement, that this guidance can be helpful to others in measuring fair value of these types of assets. It provides some guidance that these type of assets are to be measured at fair value, with changes in the valuations that are reflected in different periods and reflected in net income. Some of the guidance that it provides for these types of digital assets is that the initial cost for the asset is just what it's acquired for cash. Similar to any type of asset, even though it's an entrance price, it's also considered for fair value measurements in absence of other types of evidence and exit price under fair value. So the initial measurement at cost is typically used as fair value even though it's an exit notion. Subsequent measurements are typically measured on relative values, the type of methodologies that Antonella and I are going to discuss in a few minutes. The assets oftentimes, because of the volatility and the changing nature of different types of tokens and different types of exchanges, and its changes in technology, that there are certain situations which require an impairment of these type of intangible assets that cryptocurrency is often measured as an intangible asset, similar to things like customer relationships and all of those type of assets that we typically see in business combinations. There are the impairment uh, accounting comes into play, which this practice aid provides some guidance. Stable coins, which of course are, as we mentioned, are tied to an underlying fiat currency. They're based on such features such as the rights of the holder of the stable coin, any if there are any redemption features, collateral legal structure, similar to types of securities that we as valuation experts oftentimes or investment experts oftentimes look at when we're looking at fair value. Because we're looking at fair value measurements, um, and it's a exit notion to a market participant. Typically, when measuring fair value of a digital asset, it requires careful consideration of the market data that Antonella and I have been discussing to use to support the valuation. Next slide, please. So this brings us to how we actually measure the fair value of these types of assets. So first part is we want to look at three critical distinctions that are useful in measuring fair value of these types of assets. One, from a fair value measurements perspective, it's often there's a reliance on market value or relative valuations as opposed to internal models. And so that's a critical distinction in measuring fair value compared to some of the other methodologies that are typically used to measure the value of these type of digital assets. The fair value in its definition requires an orderly market rather than one that's influenced by manipulation. So it behooves the valuation expert to understand the market and the exchange and the volume of liquidity, because there have been certain instances where these type of assets have been subject to market manipulation, and obviously that is not considered an orderly market. Therefore, that because of that aspect of it, that may not give rise to a fair value measurement. So you have to be careful about that. There's a difference between fair value and intrinsic value. Fair value is a specific definition. It's the price to sell an asset to a willing to a market participant, as opposed to the intrinsic value, which may be value to the actual holder. So fair value is again an exit notion. So that's why there's oftentimes a focus on market characteristics in measuring fair value. And then lastly, one of the items that is worth noting is in measuring fair value in its presentation, and then Antonella's and I's article on fair value measurement, there's slight differences in our emphasis on relying on market metrics for measuring fair value as opposed to, say, for example, the CFA's white paper on valuation of crypto assets, which focuses on intrinsic value. And so it behooves us to understand the differences between the two and how valuation is applied under the strict accounting definition of fair value. Next slide, please. So starting point in measuring fair value is just understanding the asset, just like we would measure the value of any type of security. Just understand the description of the token, its total supply and activity. So document its circulating activity, its trading volume and its volatility. Understand the market actually for itself, since we're looking at an exit notion. Look at the white paper. The white paper, of course, is just the primary source of understanding the architecture and the economic rights of the token. So similar if you're valuing a complex security, preferred stock, or a stock that may have conversion rights, understand those particular features. Same thing with a digital asset. Understand from the white paper what are the legal characteristics of this particular asset and how those characteristics might impact value. The ICO, or initial coin offering, which is the fundraising method that was used to sell the native token to early investors, understand that process. And one of the keys to looking at the ICO is just understand limitations on the marketability and any restrictions that might be occur for the asset. For example, there may be some lockup provisions for the digital asset that obviously are going to affect its liquidity, which in turn impacts its value in a fair value measurement. So look at the ICOs to understand any kind of lockup or marketability provisions. And then lastly, as Antonella I've been mentioning, look at the characteristics of holding, look at the regulatory environment, which may provide an impact on its overall value. Next slide, please. So in measuring fair value, one of the first steps, since we're looking at fair value, is an exit notion to a market participant as a part of the process in looking for market participants. As valuation experts, we need to look at where these market participants hang out. So they typically hang out what the accounting standards refer to as a principal market. And as we noted on this slide and then on a previous slides, that oftentimes that's a challenge for digital assets because of first of all, the number of exchanges, which is about 1,500 different types of exchanges, but also the dominance of just two or three different types of digital assets, Bitcoin, and as a good example in terms of market capitalization and market acceptance. So there are some challenges in determining the principal market, but the accounting standards require us when we're measuring fair value is identify that participant market. So the point of this is just keep that in mind, some of these challenges, and be able to think about that when you're measuring value and documenting that particular process. Next slide. Again, fair value is an exit notion, not necessarily an entrance notion. When an exit notion means that in fair value measurement for financial reporting purposes, it's not necessarily what we bought the asset for, but what we can sell the asset to a market participant. So therefore, we need to think about value and fair value measurement in terms of what's the likely price someone would pay us for that particular asset, irrelevant of what we actually paid for it. Some of the advantages and unique characteristics of measuring digital assets that may be helpful in determining exit prices are that cryptocurrencies are traded 24/7, and they have typically high intraday volatility depending on the digital asset itself and depending on the exchange that it's actually traded on. So that leads to various answers. Where can we likely sell that? So there may be variations in price based on point in time, location, exchange. There may be alternatives on how we have to measure. Yes. How we pick what the actual exit price is depending on those type of exchanges. So is it the average daily price, is it closing price, average high low? So we need to be able to take that into consideration. So some practical advice on measuring fair value, particularly for financial reporting, is have discussions with management and auditors of what their views are as far as the ability to sell the digital asset and where they would likely sell that asset and which exchange, what the mechanism they would likely use, and what they would use as a benchmark for the potential selling price. Under GAAP, if it's a large volume of the digital asset, blockage discounts are not available, since we take into consideration discounts for lack of marketability. But we just under financial accounting standards, we can't take into consideration any blockage type of discounts. However, we can take into any discounts that might be quantify restrictions on the actual trading, the marketability of that particular asset. So again, focus on what we could sell the asset for and take each of these into consideration when making that determination. Next slide, please. So fair value measurement requires us to both under IFRS 13 and also US GAAP under ASC 20 is look at where in the fair value hierarchy these assets may fall. Level 1 are active markets for identical assets. Level 2 are inputs for other than quoted market prices for identical assets that are observable in the marketplace. And then level 3 is everything else. They're unobservable inputs. So when we're looking at digital assets, if it's particularly a digital asset that's not actively traded on an exchange that doesn't have sufficient level of volume, then typically they would fall to a level 2 or a level 3 type of asset. So unless we're talking about Bitcoin or one of the other top 2 or 3 digital assets, typically will fall to level 2 or 3 in the fair value hierarchy, which is important, obviously, in measuring fair value. So as far as fair value hierarchy, evaluate the pricing. If there are multiple exchanges, think about the volume that particular digital asset trades on that exchange and its impact on price. If you're looking at stable coin, look at its conversion and look at its backing, the collateral for that particular stable coin. As Antonella mentioned, in the U.S. under the Genius Act, it has to be a 1-to-1 collateral. Look at the transparency and consensus on the closing price and reliability of the data. All the things that we typically would take into consideration when we're measuring the value of any type of asset, but it's obviously, given the nature of digital assets, it's particularly important to take these into consideration as well. Next slide, please. So some of the special challenges in measuring fair value of digital assets, particularly given that it's an exit notion, it's a price to sell to a market participant, and taking into consideration the uniqueness of digital assets. One of the provisions that impacts its value are lockup provisions. And generally, lockup provisions are similar to securities that maybe a private placement of a security where there are restricted stock, where there are restrictions on its potential resale. Similarly, when digital assets are first issued, they often include lockup provisions. So there's limitations that are placed upon the initial acquirer on when and how they can resell that particular asset. And those limitations, of course, impact liquidity, impact marketability, which impacts the perceived value from the investor's standpoint. So that's going to have an impact on value. So if you're measuring fair value, it's an exit notion to a market participant. Obviously, a market participant will take into consideration any lockup provisions that exist on that particular asset. So therefore, you need to take that into consideration in measuring the fair value. So lockup provisions typically are measured on hypothetical puts, meaning we can measure the impact on value by estimating if we acquired a put, what would that actually, how that would impact value, and we can use that to quantify. So some of the option pricing models that we typically use in quantifying put options are the typical Black-Scholes model, the Finnerty average strike model, and the Girdov model. Each have their pros and cons. Pros for Black-Scholes, it's widely used and recognized. The cons is that it tends to fall apart for assets that have high volatility. And unfortunately, digital assets typically have high volatility, so it makes it difficult to apply Black-Scholes only in certain circumstances. The Finnerty average model assumes that the seller doesn't have any special timing ability and addresses the issue of assumed protection on the downside while still realizing the upside, which is great for our analysis. The con, again, similar to Black-Scholes, it caps inherently a discount at a little bit above 32%, which can understate the discount for lack of liquidity or lack of marketability. And that's an issue for these types of assets where volatility, oftentimes is 75% or more. The Girdov model is most commonly used because it eliminates the discount cap found in the Finnerty model, which makes it more useful in determining the impact of lack of liquidity on digital assets that have high volatility. Some of the cons, it's difficult to explain. It's difficult to implement. It's a little bit more complex option pricing model than Finnerty or Black-Scholes. So oftentimes it's a bit complex. You just have to take that into consideration, and making that use of that particular model auditable and transparent enough. Next slide, please. So one of the key inputs in any option pricing model, obviously, is the volatility. And in measuring volatility in calculating a hypothetical put for a discount for lack of marketability for a digital asset, we have a number of alternatives. I think we use the word option. We have a number of alternatives. We can look at the historical volatility. If it's actively traded, if it's Bitcoin, if it's Ethereum, we probably have enough data we can rely on its actual volatility. If we were measuring the fair value of a digital asset other than those that have enough data, we can look at an index of similar tokens that do have that data and that have a level of volatility. We can make a custom index. So for example, if we're looking at a digital asset that's recently been issued that doesn't have a track record of volatility, we can look to the volatility of other digital assets in year one, year two. And when they were early trading, we can look at their volatility and use that as a proxy for the volatility of the subject digital asset. So, just the takeaway, volatility, and it makes intuitive sense, but volatility of new tokens tend to be significantly higher than established tokens like Bitcoin or Ethereum. So, be careful when using those as a proxy. Make sure it's apples to apples. Next slide. This is just an example of how volatility measures and the impact of different factors on volatility. So for instance, if we have a very short-term type of digital asset, like a 0.11 year, 10% year, a couple months, this volatility looks to be about 171%, while the increase in the term, if we look at it, the same particular digital asset, if we look at 2.5 years, it sells near 172. So because of the measures of these volatilities, this becomes transparent, and it's helpful in the fair value measurement. Because of transparency, it helps in the fair value measurements for financial reporting purposes. It gives confidence to management and to the auditors. So this just shows how volatilities samples are taken and how some of the inputs impact the overall conclusion of the volatility that's used as an input in the hypothetical put option. With that, I'll turn it over to Antonello.
Thank you, Mark. So here we have a situation where, we saw before, if you recall, how a token typically would have a vesting schedule, so that you need to take into account. So depending on when the particular token quantity vests, the volatility is going to be different. And based on that, the discount that's going to be applicable to that particular particular vested quantity is also going to be different. And so how do you calculate the discount for the entire position? Okay, that's the question. So here we have a position in a particular token, which is 760 to 78 at the bottom of the quantity column. Here. So that's the total position, but this position vests in the quantity of 21,722 tokens per month, starting in 2023 and ending in 2026. So each of these quantities, we know what the price, the market price is, which is 49.91. So 49.91 applies to all the tranches, but the discount is going to be different depending on when the tranche vests, and based on the volatility, if we use the three, in this particular case, we use the three DLOM models. You see, each model is going to come up with a different implied DLOM, and based on this, we concluded on a different discount rate, on a different, not discount rate, on a different discount for lack of marketability. So it is very important to, because the volatility changes depending on the term, it is very important to make this assessment on a tranche by tranche level. That's the goal of this schedule, and this is a sample way on how to do it. In the end, we concluded on a fair value of, we concluded on a fair value of 50 million, to which we applied a discount of 58.24% on average. But again, this discount is not going to be the same across the board, depending on the term of each tranche. Now, some special issues for new tokens. Okay, here we had to value a token, particularly a token that was something like, now I don't recall exactly, but it was something like around 120 days from its initial coin offering. So what we did is that we looked at the volatility for each. We selected a number of comparables for these tokens, and then for each of the selected comparable, we determined what was the reference event date, the ICO, or whatever the relevant event is. We established what the date of that event was, and then we looked at the reference date, which was the same number of days from the event date than for the tokens we were supposed to value. So in this case, we took a date that's these reference dates are equidistant from the event date for each token, and then we calculated the volatility annualized based on daily pricing between the event date and the reference rate at the reference. For the reference volatility, and then we calculated the volatility 1 month forward, 3 month forward, 6 month forward from the reference date. So all this because we were trying essentially to generate some estimates of what the volatility of our token could be, but based on by comparing essentially apples to apples, so trying to look at not the volatility of Bitcoin today, but the volatility of Bitcoin from the time of the initial coin offering up to the reference date, which can be matched to the volatility of our token from the initial coin offerings to 120 days after the initial coin offering. Now, I hope this gives you a sense of the complexities that are involved in volatility assessment, which is really the critical parameters in determining DLOMs and for token valuation. Now, moving on, aside from actual tokens, there has been, there is a market out there which has developed for special types of contracts, which are called simple agreements for future tokens. So these are contracts where the parties basically the crypto developers offer these contracts sometimes to accredited investors, where investors provide capital to the developers in exchange for crypto tokens at the future date when the development will reach that level. So these are situations where there are no crypto tokens or at the moment in which the investment is made, but there is an expectation that at some point in the future such tokens are going to be issued. So how do you value these contracts? I mean, there is not even an existing token. And often also serves as as special provisions. They may have a discount provision, they may have a valuation cap, and also they may have different terms depending on whether the trigger event does or does not occur. So in some cases, there is a provision where if the token, for instance, is not issued, the money goes back to the investors. Or there could be no provision, or there could be a provision that the SAFT is worthless, so that the investors are actually bearing the risk of failure in developing the token. So this is an example of a SAFT term sheet. I mean, these deals, as you can see, can be quite complex, but the basic point is that you have to start in a situation like this with a calibration model. So given the amount of money that you're investing, you as an investor must have some level of assumptions on what you think when you think this token may be issued, possibly, give it a price that you think may be most applicable, and essentially develop a model, a calibration. In this case, we have two scenarios. We have a scenario where there is a token launch, and there is a scenario which has project failure, and there is a probability that has been assigned of 70 and 30%. So at this stage in the game, you have a lot of leeway in how you're going to set up your initial calibration model. But then once this model is set up according to your best estimates of all the various probability weights and assumed token price and all that, once this model is set up, then what you do at subsequent dates, you update it. So how is the project performing? Is it doing better or worse than expectation? Has the probability of a token launch increased or decreased? Has your assumption on a future token price improved or declined? So based on that, you can kind of recalibrate it, and you can build an argument to support why the price now, I mean, the value of this contract now is higher or lower than it was at inception. Okay, so moving on now to a topic that's also very important for token valuation is the situation of market manipulation. I mean, this is a risk which is especially, I mean, it's very relevant for I would say the majority, probably, I mean, a vast number of tokens that are out there in the market, particularly because once you eliminate the market leaders in terms of volume, there is a lot of activity out there. There are lots of tokens out there which have relatively light volumes. And there is one particular case that was brought about the U.S. Securities and Exchange Commission in this area that specifically focuses on market manipulation. And it's a good example of what can happen in the crypto markets and how market manipulation can occur. So this is a case that was filed in 2024 against a company called ZM Quant Investments Ltd. So this company had engaged in trading for two particular tokens called NextFun AI and Saitama, which use the Ethereum blockchain. And basically what happened is the company created artificial trades in its clients' crypto assets to artificially inflate the price and the trading volume. So the trades were taking place in such a way that a market participant may have the impression that there were multiple parties trading in those tokens. And also, ZM Quant was receiving a fee on the trades that it was generating. But the main thing is that, people looking at this market, they got the impression there is a lot of activity from a variety of market participants. So they were, in some cases, people trade on quantitative models, or in any case, I mean, they may have gotten the impression that something was going on with these two particular tokens that would justify entering the market and with a buy order and inflating the price. So this was clearly a situation of market manipulation. The crypto market is susceptible to that because you may not be able to see who is putting the trades in most cases. And also, another effect of this manipulation is that it affects a DLOM analysis. So if you look at the discount for lack of marketability, that volume considerations are important, price volatility is important, and you may come up with a DLOM if you're not aware that there's this type of activity in the market that is not really suitable for the instrument that you're valuing. So market manipulation is an issue that we have to pay special attention to. So these are various types of market manipulation situations that are described in the EACVA Certified Digital Asset Valuator Module 3 material. So you can have a situation of wash trading, which is what we just described, basically inflated trading that sometimes people do with themselves and or with client accounts that doesn't correspond to actual market but independent market participant activity. So there could be situation of pump and dump. So try to inflate the volume and give an impression that there is activity, and then eventually sell your positions to people at the time where other participants are entering the market. There is there can be situation of spoofing where the order book is not at face value. The order can be front running. So these are fairly I don't want to say common, but situation that we have to watch for. So always start with an analysis of the trading volume to try to identify if there are unusual patterns that may suggest this type of situations. So in terms of before we close, we want to give you a few references in case you wish to deepen your knowledge of digital asset valuation. So Mark and I have some work on this matter. We together released an article for CFA Institute BLOG Enterprising Investors on how to value digital tokens. There is also a webinar for business valuation resources on the valuation of crypto companies. And there is an ACPA crypto podcast on the valuation of crypto assets and crypto companies, which is publicly available upon subscription. And then there are many other sources, of course. We just mentioned 3 of the most relevant CFA Institute, the publication on the valuation of crypto assets, a guide for investment professionals. They come out in 2023. Then there is the digital assets practice aid of the ACPA that Mark briefly discussed earlier. And then I do want to point out the great work that the European Association of Certified Valuators and Analysts has been doing in this space. They have developed a credential, Certified Digital Asset Valuator credential, that very recently, and they put together basically in order to have this credential, you have to take an exam and study certain materials. They have put together a great collection of materials specifically on the valuation of digital assets. They have done publications on this topic, and they are really taking the lead in helping the profession reach a standard in this space. So if you haven't looked at their materials yet, is definitely something that I would strongly recommend. And with that, we can open the floor to questions.
Antonella, Mark, thank you for this presentation. So the audience, we are ready to start the Q&A session. Please raise your hands so that we can. Oh, okay. Alternatively, yes, you can also write the questions in the chat. So then I will read the questions to you, okay? So actually, we have like two questions here. I will start from the last one. So are there methods to factor the influencer or public figure effects on the value of a token? Antonella, Mark?
Yeah, it shows up in the data. So there are um, various, like for example, the Trump coin or something like that, where an influencer might cause people to purchase that particular digital asset. And I think the best way to measure that impact is just in the data itself and see how it, with those how it impacts the price. So I think that's probably the best methodology.
Yes, and I would agree with that. I mean, this is a case of you can have a situation of market manipulation. In that case, that could be, for instance, a situation of pump and dump, where somebody is giving news or disseminating news to inflate the price of a particular token, so that they are able to to dump their holding. So again, volume review is a critical aspect of digital value asset valuation. I would say it's something that needs to be done very early in engagement to try to identify any unusual patterns. And if you see unusual patterns, look at the news, look at Bloomberg or other sources of information to try to understand why there was that change or that unusual increase in volume for a particular period.
Okay, thank you for the response. Then we have first one question was likely more philosophical. So the tokens we were talking about today, should we consider this more as a commodity or a currency? So how do you think?
Um, for financial reporting purposes, so for fair value measurements, there's typically kind of a hierarchy that want to go through to get to kind of a conclusion. First, to meet the definition of a currency, it has to be considered legal tender under accounting standards. And typically, digital assets like Bitcoin and such don't meet that requirement. So that generally, they're not considered currency unless it's considered legal tender for some reason. So there might be situations, for example, when it's issued by a central government or a reserve, a federal of a entity, but most cases it's not currency. So the second it kind of defaults to, is it a financial asset? And it could be considered financial assets under financial reporting if there's a contractual right um, to convert it into some sort of currency. And again, most digital assets don't have that right. So it doesn't meet that test. So it's for accounting purposes, it's not considered a financial asset if it doesn't meet that test. So the default answer generally is that for financial reporting purposes and fair value measurements, that these type of assets are considered intangible assets. And that's how they get reported on financial statements. So they fall under um, the guidance for intangible assets. So they have to be subject to an impairment. They're initially recorded at cost. There are rules, particularly under US GAAP, that they have to be remeasured each period and then adjusted, in which the adjustment goes through net income. So typically you'll see them as intangible assets unless they meet those other criteria I mentioned.
Okay, Mark, thank you for response. So we have one more question in the chat. Okay, so I will read it now. How are smart contracts and other actual utilities of crypto factored into the fair value of a token?
Well, I would say for the fair value, I mean, to the extent you have an exchange, you have trading of certain tokens, utility tokens on an exchange. From a fair value perspective, the prices coming out of the market are still gonna be the leaders of the analysis. And I would say, if you have a particular token agreement, you have a startup company, for instance, you may have certain tokens that are traded, and then maybe they issue the other tokens that have different features from what's being currently offered in an exchange. You would take a look at those, and they may or may not result in pricing adjustments, depending on the nature of the contract and the rights that it assigns. Yeah, so I would say it's a case by case situation on how you would look at those other rights. Yes, in a way, I mean, that's not dissimilar to what you would do for a stock, private equity security that has different features or that give you special rights.
Antonella, thanks for response. So as of now, I don't see any additional questions in the chat. So, one more just recently. I will read it. Okay, thank you for the question. So what criteria do you typically use to estimate the probability of a token generation event or similar triggering event occurring in the safety verification?
Safety. Well, first of all, you would look, I would say the starting point for that assessment is probably the white paper. We would read the white paper carefully to see what in there, if there is in there any sense of, sometimes management tends to discuss their plans, their expectations. So we would look at what they have presented in writing, and then we would also discuss it I mean, if we're valuing something for management purposes, we would have a call typically with management to better understand their forecasts and their projections. And if on the other hand, you're on the passive side, you may hold these tokens. You may have, in order to invest in the company, you may have your own view of when a possible token may be developed. So what is important though is that once you have defined these parameters at calibration, and you have a broad variety of situation, a broad range of expectations that you can develop, and also, I mean, the idea is that eventually this analysis ends up consolidating into what you actually paid for that security. So whatever probabilities and assessments you have, at the end of the day, you have to reconcile them with the price that you paid to enter the contract. But once you have that infrastructure in place, then you cannot just change it randomly. I mean, at subsequent measurement dates, you are kind of stuck with that. And if you want to change it, you have to have a reason why your expectations have changed. And I don't know, Mark, if you want to add something to that extent.
Yeah, I think for me, it goes back to, the classification of an intangible asset. So it's generally the similar things that impact impairment for other types of intangible assets, at least what I've in my view and what I've seen. So if it's something that is that, as Antonella mentioned, if it's something that impacts the overall expectations, if there's some market condition, if there's a new regulation, if something external impacts the overall the expectation and it changes that, then that may lead rise to an impairment in a revaluation.
Thank you for the detailed response. So are there any questions, audience? So please let us know.
Yeah, one thing I want to point out, which it's also I think is striking, is the fact that you can look at these assets. If you look at it from the perspective of an investment company, just keep that in mind. We are still in the fair value framework, but there are two different perspectives. One is you have a corporate entity that holds digital assets. So the intangible guidance applies. On the other hand, you may have a private equity fund that holds, for investment purposes, digital assets. And there, the ASC 820 and the ASC 946 investment company guidance applies, which tells you that you have to fair value them, whether up or down. You have to consider both directions. So if the asset is, you think the fair value has increased, you would increase it. If it has decreased, you would decrease it. So the approach to the valuation, even if it's fair value, is going to be, the way you look at it is going to be different. And I think, the perspective Mark presented and the perspective of an investment company would be slightly different in that regard, particularly in terms of what would involve a revaluation of the assets versus just an impairment.
Thanks for this clarification, Antonella. So colleagues, the audience, are there any questions? I think we can still have wait like 1 or 2 minutes to give you more room for additional thoughts. So otherwise, I will give thank you. Say a big thank you to Antonella, Mark, for presenting this interesting, I would say, unique topic. It's a rather modern topic for evaluations subject. And I will also thank you to CFA Society Ukraine for organizing a series of evaluation workshops and this workshop in particular. And maybe some closing remarks to Antonella and Mark as well. Please, the floor is yours.
Thank you very much. We appreciate the opportunity to present to you, and feel free, if something pops up later, to reach out either through the CFA Society or contact Antonella and I directly. I'm happy to answer any questions you have.
Yes, thank you very much again for inviting us. I hope I'll soon have a chance to visit in person also, and it has been a pleasure to be with you today. And please don't hesitate to reach out to us also by email. We have put our emails here. We didn't put our phone numbers, but you can just you just email us, and we'll be happy to have a call if you wish, and stay in touch in any way possible.
Thank you, Mark. Thank you, Antonella, for such an interesting webinar. Thank you, Andrei, for moderating. And thank you, every one of the participants, for joining us. Stay tuned for more initiatives from our side, and have a nice day.
Yes, have a nice evening. Goodbye, everyone.